Warriors. Hi, Warriors. How are you today, Ingmar? Everyone doing okay?
Hey, Dale.
Hey, Ryan, Kay.
Good morning, Dale.
Everything okay, Kay?
Yeah, very okay, actually.
Okay, so there's the yen.
There's the
Woohoo!
Okay,
flying
so
into the moon.
okay, targets.
I've got some stuff around 137.20.
Okay,
But an overall target? No idea.
okay,
I mean, the thing is, I bought it this morning, which is pretty great. I messed up a euro dollar in the meantime, but that was only like a relatively small pain. But yeah, I bought it this morning again because it was feeling very big. Risk was doing well. Yields were ticking higher again. So I bought the dollar yen again this morning. Again impulsive since we've broken through the prior highs. It's done a quick 60 points already. It's a case of one day it's risk and yields, the other day it's Bank of Japan, and then a combination of all. That's a very explosive cocktail for yen pairs, right?
yeah, and benign neglect, right?
Yeah.
They like it. I don't know. I was
Well,
reading something about
but it's
that.
crazy. It's crazy
You know,
because they should have waited until the economy and reopen. The economies reopen effectively when the supply chain issues are going away. That's where I would understand that countries like Japan, even China, would like to see their currency weaken to prop up the exports again. But for the time being, as long as there are issues, I don't see the reason why they would be really happy with a weaker yen.
yeah. So anyway, this is the first time since the huge move really began, that big breakout, that the RSI has now confirmed a new high on the daily, and a lot of time frames exactly. Not saying that it won't if it keeps straight lining. Shorter TFs were confirming 15 minutes, big confirm. So short term, you can't take the other side of it. That's for sure because of the a lot of momentum.
Yeah.
And you said something about the euro. I don't know. Is the bottom in, or is there one more decline to under that 103.50? Looks like we start trading over these highs. It's going to look pretty good.
Mm-hmm.
I'll be interested when Blake comes on later. He had a downtrend line when he said last week that the euro, the risk was tilted to the upside, and maybe we're cracking it or attacking it.
Yeah, again, the move today seems to have had a lot to do with higher equity markets, which with the algos firmly plugged in, having sold dollars versus everything, barring barring yen and probably Swiss also. But it feels to me like we are waiting in this range, seeing where the next move will really come from. As you say, there are some decent topside levels to monitor for a break. But equally, we are not breaking yet. So, in my opinion, those currencies are like euro, dollar, are a little bit in the range right now, and we are going to wait and see what happens because the German gas situation is not solved yet. Macron will be wrestling with his government. Extreme left have already said that they would not support much of his plans. So I don't know whether the euro really has enough strength to break out significantly. I'm leaving it in the middle right now.
Okay. Yeah, because we could still fail here and take out all the longs, get the DSI back under 10 again. I mean, this doesn't say that we bottomed. It's a rally attempt, but it looks like if we start closing above today's highs, the shorts will be under a lot more pressure, especially back over maybe the big round number 106 might pressure them. You seen anything in the options market as a tell, Ryan, in the euro or any of the other currencies?
No, it's still very quiet at the moment, mate.
Yeah.
Very,
Okay.
very quiet.
All right. And I guess, commodity currencies, Aussie, is that a bottom, or are we going to try the line underneath it, which probably isn't extended for, oh, there it is. Okay. Comes in at one of the alarms that Blake probably has set 67.5. So, Aussie
Oh, we ain't
actually
going there. We're
not that far down. Like,
no way. No.
Okay.
No, if we do, I'm gonna start buying it even with Ryan's money down there.
Okay, because I know that these look like you have these alarms up here for some reason.
Oh yeah, it's like you put.
Oh, there's an ABC completion.
Yeah.
All right,
Yeah.
I see now. Okay, it's mainly Amanda with those alerts on my screen.
The problem is when you put out those alerts and then you forget to delete them, they just sit out there. So
okay, all right. So what your impressions with what's going on?
I don't know. I want to go back to the yen and good morning, Kman. Good morning, Ryan and Dale. Obviously,
hello.
And,
Good morning.
Stel and Stel's
Hello.
of course he's here. I was hoping he wasn't going to be here. Oh, he's here. Hey, Stel. No, I was actually going to ask Kman. The reason why I tweeted this morning 137 is just because it's a round number. It sounds better than what I was going to say. But I was looking at in here. I'll take the screen from you, Dale.
All right, man.
Let me get over there really quick. I was looking at the dollar yen price action has been very bullish since you were just talking about the BOJ. And I can't figure out why the hell that they're not trying to firm up the yen. I mean, I was looking at commodity prices. At least commodity prices are starting to come down a little bit, which has got to help them at least a sliver. But looking at the dollar yen following the BOJ last week, the pullback has been very minor. So that one of the things that I pointed out on the week ahead video is just reading price action. Talked about the price action of Bitcoin and what suggested there would be more downside. It's the same thing as the dollar yen. You get this rally and then you get a tight consolidation right at the highs. Well, of course it's going to break out. So here we are breaking out. I think we see the 127% extension, which comes in around 136.70. But where are you targeting dollar yen? Because I missed it.
Okay, I was saying 137.20. I got a level which stays from quite a while ago. I saw some technical extension here at 136.20, but it's not part of my dictionary, some of those. But no, to keep it simple, I think at 137.20 is going to be a zone, and then we have to look at the speed. I would be really surprised if they do not comment on this move, because yen really weakened across the board today. There's not one yen pair, unless I have missed it, that is lower today. Yen just got slaughtered.
Yeah, and I was wondering, well, actually, there was a couple comments in our chat rooms this morning, and here, I'll show you one of the traders, DK. He came in. He was like, he was talking about the Aussie and the Kiwi, and he said, they were like really weak, and I said, well, that wouldn't have said it a couple hours ago, because 3 hours ago the Aussie and the Kiwi were looking really, really good. By the way, this is the ForexAnalytix chat room. You want to see the conversations that has happened just since I've gotten up, and it's been a slow morning. Boy, it's like everybody's still on vacation. You can see I got up probably around here about an hour ago, somewhere around here. Oh, wait, hold on, still going. Yeah, somewhere right around here is where I got up this morning. So you can see how active that chat room is, and that's not even to include like the here's Ryan and Kman in the Flowonomics room, which is the more of the macro chat room. I was just saying that DK was writing into me like, hey, the dollar yen, or excuse me, the Aussie and the Kiwi are so weak. And he's like, I wonder why. And I was sitting there just as we started, and I'm like, where it was the breakout of the dollar yen that really kickstarted that move higher in the dollar across the board, which ended up reversing, the Aussie and the Kiwi, even the euro, sterling came off, as the dollar yen started to pop higher. And I guess I wanted to make that point because the dollar yen has really led the charge in the dollar index. Like, I want to say like the last several months has been the dollar yen. So if the dollar yen, maybe peaks around the 137 level, maybe 136.75, where Kman saying maybe that's where you start to look for a turn higher in like the euro, because I am expecting the euro to eventually break higher. I know a lot of people are going to trade this on the short side as we approach this this descending trend line, because it is
where's that come in, Blake?
What's that?
Where's that come in?
Comes in around 106.50, 106.30.
Okay. Yeah.
Depends how long it takes us to get there, but it's going to be coming in right around there. And I think a lot of people are going to try to play the euro on the short side. I'm still a euro bull, or actually, let me take that back. I'm a dollar bear currently. But what are you guys' thoughts with the dollar and the euro? Let's start with Stelios, since Stelios is brand new to the party. Just got here. I know you just got here. Me too.
I think in the very short term, we said this on yesterday. I think very short term we might see a push towards the lows in the euro dollar, those lows, and they might even get taken out, and that would be great if you see those get taken out and then reverse back above. But if you ask me what I think, 6 to 12 months from now, this pair is going to be, I think, is going to be quite a bit higher, and that's because I think I've said it again yesterday. The Fed is doing a lot more than the ECB, but the market's already pricing quite a bit, and we're seeing that the Fed tightening is definitely bad news for the global economy, really. So the world cannot stand a strong dollar, not for long. So I think the ECB is going to catch up, and I have a small long in the euro dollar, but I'm going to add substantially once we get, I know it's not close, 108.1 on a daily close and above.
Okay. Well, so you think on a daily close above 108, well, that would actually technically give us a double bottom. And then that, and by the way, a move above 108 would actually target like 112, 113. So, I mean, that would be a hell of a move. And I would have to imagine that risk, when I say risk, stocks are going to have to recover, crypto is going to have to recover, yields are going to have to come down substantially as a result, but that's all possible, right? I mean, Dale, we were talking about this yesterday in stocks, we maybe a near-term low is in, right?
Yeah.
I mean, it is possible. So let's hear from Dale. What do you think about the euro? You have any opinion on the euro here?
Neutral with the longer-term bullish bias. I'd actually like to see what Stelios described happen and clean out if there are any longs left, take out the 103.40 level first and then close back above it is kind of the action I talked about yesterday. What's interesting is Jean-Francois, who I've interviewed, is saying that the SDRs are changing in July. That's the IMF's basket of currencies. You guys are fundamentalists. Kman, Ryan, any comment on SDRs and that they're going to be changing maybe the percentage of the basket? That could be a market. Could that be a market mover?
Not that I've seen anything like that, but it's not something I look at closely. Don't know about Kman.
Okay.
No, I haven't really seen the details about what's going to change, so I'll have to look it up.
Okay, because he's an aware guy, so it might be worth looking at it. Anyway,
Okay, if I may, was it going to change in favor of the yuan again?
That's what
I meant to have read something about that, but a few months ago.
Okay. Well, I guess officially they're doing it next month.
I'll look it up.
Okay. And
shoot.
yeah. So
go, but that's
ahead.
You know what's interesting that you just said that. I've been meaning to tell you guys this, and I'm sure most of you have seen this. Maybe you haven't. There's a YouTube video. Gosh dang it. You know what? Forget I even said anything. I'm gonna find it and then I'll talk about it like tomorrow. Because I want to be able to find it and then tell you guys about it. Rather, I'm gonna sit here and stutter the whole time, but it has something to do with like longer term change of the US dollar and the yuan. Anyway, I'll come back to that a little bit. That's interesting. So
Paul talked about that, I think, last week, wasn't he talked currency.
What do you think? Why do you think that if this SDR change, let's just say it happens, who do you think it's going to favor, and who do you think is going to is going to be what currency is going to be a beneficiary? I guess the question I would ask. Like, you have any opinion?
Everything but the dollar. Everything but the dollar.
Everything but the dollar. Like is this an anti-dollar change?
Yeah, it is. It's part of the movement away to kind of strip the reserve currency status away, de-dollarize, and make it more, in their view, more balanced.
What do you think, Ryan?
As I don't really know. As Dale says, it's going to be against the dollar, but it depends how they chop it about. If it's tiny stuff, it's not going to make a blind bit of difference. I'd have to look it up as well. I don't see what huge impact it will have on FX trading as we see it.
Yeah.
No, okay. Yeah, on trading, you're not really going to see much anything, right? Yeah, but okay. Well, Ryan, how do you feel about the euro just in general?
I think unless it starts breaking some of the old levels that we've been looking at for eons. This morning I thought that it looked a little risk on, with the yen pairs jumping, dollar yen was caught in the crosshairs, euro dollar seemed to be dragged up rather than leading the pack. 106, the close numbers are 106, 106.35, the former break area that became support. If we can't get above those sorts of levels, you can forget and move to your 108s and things like that. So it's really looking at the inside range, which is probably 105, 104 to 106, 6.5, and then the wider range down to those 103, 40 lows and up to 108 on the wider. Trade the edges until they start breaking.
By the way, Jean-Francois just put the link up about the special drawing rights.
Oh, okay. Thank you, Jean-Francois. That's great. You know what? And I was going to give this to you guys because it was really it's very easy watching. You guys should watch this. And here, let me see if I can grab the link for you guys. Hold on. It is it's from Ray Dalio, and I'm sure you guys have seen it. I mean, it's had 41 million views. Wait, hold on, I'll tell you. 372,000 views since March. So it's been a month and a half. Have you guys seen that video? I'm going to put it in the chat box for everybody. Anybody seen that?
What is it about?
Is that by himself or with Grantham? He did one with Grantham.
Yeah,
no, this one, and I put it in the chat box so you guys can all watch it. It's Bridgewater puts it together. It's about his book, but it's 45 minutes. It's very animated and it's actually really good. You guys should watch it sometime, and it just talks about like more of the cycles of power. From the change of power, when
Asia.
Britain lost its power, then the US came in, right. And then Dutch before that, and then then here comes China. It just shows you how like everything works in cycles over years. It's a really interesting. yeah, everybody's saying that a lot of people have seen it. You guys should see it. It's really good. It talks about currencies in there too. So, and it's very basic. I mean, you guys are gonna be like, I trade currencies, blah blah blah, and you know, you're gonna be like, I understand all that, but no, it's more of like the cycles of power and the rise of China really is what it is all about. And you know, it's and you know, when you talk about the yuan or you know the renminbi and how it can actually ever be, you know, take the dollar's place as a reserve world currency, you know, based on, you know, Ray Dalio's thoughts, it eventually will, you know, and we look at it more near term and say, well, how's that even possible? They don't have like the, you know, the markets and, you know, to sustain the depth that we need and investors need, but they're working their way towards that, you know. Cammy said it was a 500-year years of history. Yeah, it's like 400-year cycles, really, is, you know, so it's good. Yeah, you guys should watch it. It's a good one. Anyway, totally off topic, but I guess going back to where the you know the SDR topics, that's like kind of an interesting you know dynamic as you see de-dollarization. I think we are in that you know that mode, and we have been really for the last 20 years. I can remember back before the Lehman Brothers collapse, you know, how Russia and a lot of the Middle East were really trying to you know, and with China's help as well, trying to move away from the dollar way back when. And that trend is going to continue. You know, it's going to continue as we move forward. But you know what hasn't stopped though, if you look at the dollar, you know, just over the last, you know, I guess you can go think since the financial crisis back here, and you can see, you know, everybody was bashing the dollar. That was about the time that Giselle top ticked the euro, and she also top ticked Bitcoin, if you guys didn't catch that last year, by the way, right?
Who's Giselle?
Come on, man.
Are you crazy, Dale?
He's married to that quarterback. What's his name?
Oh, I don't
Brady?
know. The greatest quarterback of all time. Yeah, it's
well,
yeah.
Tom Brady.
Wait. You mean Joe Montana, right?
Yeah.
It's Giselle. She remember when she said, "I only want to get paid in euros." Do you remember what year that was?
At the lows, right?
It was the euro. It was end of 2007.
Yeah,
maybe.
Okay. Yeah.
So she's like, I only want to get paid in euros. I think the euro is 157 at that, or 156 at that point.
Oh yeah.
And then she does a commercial with Tom Brady for Super Bowl Sunday regarding Bitcoin.
Yeah.
And you know,
that's why he's coming out of retirement. He really did trade Bitcoin.
Oh, I'm
that
sure
commercial.
You know, you know, half those guys
Poor
that got
Tom.
Free crypto, they don't even know what the hell they got. They're like, what is this crypto crap?
Well,
just say
that
these
was a
lines.
trade he made.
Right. What's
it
that?
Well, the commercial says he wasn't trading anything on the fields. He was trading crypto live on TV. So he had to come out of retirement.
Probably. All right. Well, let's we can probably continue on. Hey, have you guys noticed the slump in commodities here? Take a look at Nat Gas. Nat Gas has come off pretty good. I mean, what you guys making anything of this? I mean, check this out.
I just want to make just a small note on Nat Gas. You can look at Nat Gas, this one in the dollar side, but the European gas is a different market, and that this one has been going down. But in contrary, the European gas market, the Dutch gas market, has been going up. I think something like 47% in the same time.
Yeah, James in the chat room said he said the German Bundesnetzagentur energy regulator chief says, looking at, and I can't pronounce that name, looking at winter from today's perspective, we would have a problem. So what is the symbol
Germans, by the way,
gas?
by the way, Germans are restarting or upping their coal based energy, right? They're shutting down their nuclear power stations, and they're going back to coal. Great. Sorry,
that's a new definition of green energy.
Yeah, carry on. Sorry, I didn't mean to interrupt.
No, but what's the symbol for European nat gas, Kman? Do you know?
No idea. I just see
F.A.R.T.
What?
F.A.R.T.
F.A.R.
I almost
That's a good
typed
one.
it. You almost
I
got
know.
me to
I
type
thought you
it.
was going to type it there.
I almost did. That was a good one. That was a great one, Ryan. By the way, I now I'm laughing inside. Actually, it's all right. Let's one last thing before we bring on Danny Blanchflower, which is going to be Dale's guest. And by the way, if you guys if you guys and gals don't know, Danny Blanchflower used to be a there with the Bank of England. So it's always nice to have him on here. He's really has some. He's very opinionated. Love listening to him. But let's talk a little bit about the.
No.
Let's talk about the S&P. We talked yesterday. If you guys weren't here, if you were enjoying Juneteenth and off yesterday, we were challenging channel support, and I'm going to come back to that. Some of those targets, but you guys know I'm not bearish down here. I mean, overall, I think the markets are coming lower, but I think sentiment's a little stretched. I know I've said that the last few days. So I'm not really trusting these moves down here. But we really have to get above 3,800, get a nice daily close above 3,800, to get back over to 4,000. But look at equities here. We're more than 20% off the highs for the year. I mean, the year started here. So if you look just at the S&P, we're down. Well, actually, let me redo that again. Let me do that one last time. We're about, down 22% for the year. Currently, we've been down more than that. It's, hard to get bearish down at these levels. I still think we're going to bounce. You guys have any opinions on what's happening with the SPOOs here? Steve, we heard your voice. So what do you think about the S&P down at these levels?
Nothing has substantially changed here. A little bit of a consolidation. Potentially, we can see a little bit of a bounce, but
so if you're looking out a month from now, would you rather be on the short side today in 1 month's time, or on the short side, or on the long side?
In my opinion,
a month from today, are we going to be higher or lower?
In my opinion, we're in a clearly bearish trend. Not so much because of the percentage we've already lost, that we're officially in a bear market, because I felt, and I was short, and I'm still short from a lot higher. We entered the bear market very, very early in this downtrend because fundamentally everything has changed. So absolutely short and absolutely bearish a month ahead.
Oh, okay. So a month from now, you think we're going to be lower? Okay, Stelios, Steve, or Stelios? Sorry, Steve, Stelios.
I think we're going lower, but I think we're going to see a little bit of a squeeze before. But I think my macro buy is still firmly bearish, with central banks tightening, inflation rising, disposable income reducing. This is not good.
All right, Ryan, what do you think here? You guys were right when I said 4,300, 3,800. You guys all had it right. And so, what do you think now?
38.11 is the number. Can't break that. We go back lower.
Okay. All right. Kman, you have any opinion here?
No.
Dang it. I wanted to do an opinion. No opinion. That's not good.
Itself.
All right. Dale, what do you think here? I think Dale disappeared, probably because Danny Blanchflower is going to be here in just a few moments. All right, guys. Well, did we have any news coming out today? Steve, Stelios?
Retail sales. Canada retail sales, and then later existing home sales from the US.
All right. Well, since we got Canadian retail sales coming up, and I do think data matters nowadays, especially in a world where inflationary pressures are biting the consumer. Let's take a real quick look at the Canadian before that data comes out. So the dollar CAD or the loonie, for most of us is trending higher in a nice ascending channel. But what we've had recently is we had this high at 130.70 really stick the market. Now, I know a lot of people are thinking, oh, that's a double top, but that's just, as far as I can see right now, it's just really key resistance. Although I did get short at 130.65. Most traders know that from last week, and I'm still short. So I'm still running a short in the dollar CAD. If you guys are in the ForexAnalytix, community, you go over to the trades room, you can actually see my open positions, where I posted them yesterday right here. You can see like my dollar CAD short from 130.65. So, and I'm still short. I'm still running.
Data in 10 seconds.
All right. And so the data is going to be coming out, and let's see what happens here with the market. 38% retracement should be support. 128.60. Do you guys see it anywhere? Oh, there it is. A little bit weaker retail sales, as you would expect. New housing prices coming off.
No, retail sales were better. 0.9% versus 0.8% expected. 1.3%.
Just going to say these are still April data, and globally speaking, we have seen a weakening in data starting in May. So these are still April data.
And look at the revisions were actually higher too. So let's see if the dollar CAD. I mean, look at the CAD's actually firming on that right now. So maybe those revisions have really helped out a bit. Anyway, it's going to be interesting to see that dollar CAD. I think we have to see how it responds to this 38% retracement. This is going to be very critical support for the bulls, moving into the remainder of this week. But if we continue to see risk on, and we see markets continue to press a little higher, maybe we get the S&P back towards 3,800. The dollar CAD should probably head back below, 128 moving ahead. So, guys, I want to thank the entire team for being here today. Dale, I hope you have a great interview with Mr. Blanchflower. And then I also want to say, guys and gals, if you haven't tried out ForexAnalytix, make sure you do so. It's only $1 for 10 days. You can jump in the community because you'll get the premium service for those 10 days. Make sure you download the mobile app because you'll get all these alerts and notifications right to your phones, your mobile devices. And that comes included with not only the premium version of ForexAnalytix, but also the light version, which is only $20 a month. So with that being said, Dale, have a great interview. Thanks, team. And I'll catch you guys on the Morning Edge, which is for the ForexAnalytix subscribers here in 45
Cheers, guys.
Thanks, everyone.
Thanks very much, Dream Team.
Hello.
Danny Blanchflower, welcome back to F.A.C.E. Danny.
I should have said Dr. Blanchflower. I said Mr. and I should have said Dr.
There he is.
Blake, let me
there
just
he
say, Blake, I have 4. So I'm actually doctor.
Oh my God. Quad doctor.
Quad.
Well, thanks for joining us today, sir. And I'm going to leave you guys to it.
Of course.
All right.
All right, Doctor. Welcome back. How are you?
I'm good, man. I want to show you a picture.
The fish you caught? All right, go ahead.
Oh, no. Can you see that picture?
Yeah.
Okay. This is the crucial picture for today. Would you like me to
My
talk
psychiatrist showed me these ink blot things.
Can you see the picture?
Yeah, we got it.
Okay.
Yeah.
Yeah. So we've been hearing about, the US soft landing, supposedly, says Chris Waller. And we hear today about Larry Summers talking about how we have to keep wage pressure down and we have to raise the unemployment rate. So this is the most important chart for listeners to this program to look at. So this is a random scatter of points, right?
Yes.
And if you look, there's the line that fits it is an upward sloping line. Well, that's the basis of Larry Summers and the Fed's view about wage growth. This is the US wage Phillips curve, which is supposed to slope down from left to right. And it actually doesn't. There is no evidence whatsoever since 1965 of a US wage Phillips curve. There is no evidence whatsoever that the unemployment rate impacts wage growth. That's it. So this is the longest series we have from 1965 of production and non-supervisory workers. So you simply plot it. You can get it from the BLS. All your listeners can just go to the BLS, you mess about a bit and you can get it, and then you can plot it against the unemployment rate. So here the first thing is that there is no relationship. There is no wage Phillips curve as asserted by all these central bankers and everybody else. So they try and do stuff and say, we need to go and think about something else. We'll mess with the horizontal axis. We'll mess with the vertical axis. But just so listeners understand, Phillips in 1958, in the most famous paper in economics, published in Economica, wrote about the wage changes and unemployment. So the Phillips curve is about this. So the problem that we have is that unemployment appears to be uncorrelated with wage growth over a long period. And also since 2008, it's uncorrelated with wages as well. And so all the arguments made in 2015 to 18 by the Fed, which is that unemployment's falling, wage growth is going to take off, turns out to be entirely wrong, because unemployment was uncorrelated with wage growth. And exactly what happened, as the unemployment rate fell, wage growth didn't take up. So here we have a big problem, that you shouldn't use the unemployment rate for an indicator of much of anything. And I'm going to start this off. I think the idea that the US is going to go to a soft landing is for the birds.
Well, Danny, you were calling, you said we were in recession last time we talked, which was
Right.
3 months ago. All your data was pointing that your happiness index was turning down even before that. So it's they're sealing the deal with rate hikes.
I think that's right. And I think the place is that particularly the UK now looks an interesting place, not least for the very first time in many, really lots of decades. There's a large national strike going on in Britain today of the workers on the railways. And there appears to be quite a lot of support in the public. The government's trying to say these are all a bunch of loony, left-wing militant union people. But actually, you certainly wouldn't argue over the last 25 years that much of anything in the economy at all has been determined by overly powerful unions or by workers getting major wage growth. So we have an issue here, which is that, you know, we can argue about whether a wage price spiral is coming or whatever, but what's happened is that inflation has risen. The governments around the globe appear, well, certainly the UK and the US, have been pushing very tight monetary fiscal policy in Britain, highest tax rates in Britain for 40 years. The central bank raising rates, and with dissenters are really about raising it by more. And you have ludicrous speeches yesterday by Catherine Mann and others who really don't seem to understand about the data or the real world or the mistakes that they made in 2008. So I think it's very likely that we will see very strong data revisions coming, which suggests that, you know, we're in recession, knowing that in 2008, if you look back, we didn't officially know that recession started in December 2007 until December 2008. It took the NBR a year to say that we were in recession. And in the UK, it really took until around July 2009 to actually know that recession started in April 2008. So I think you have to be very cautious here, understand that data takes a while to come in, and oftentimes at recessions, revisions come, but we know when recessions hit that revisions actually are to the downside. So I think evidence on retail sales and other things are big. I think the evidence on timber prices, which are tumbling,
I saw lumber back down at 500, which used to be high. That used to be high, and now
it went up and it went down. Yeah, it went back up again, but now it's plummeted again. Apparently, microchips, that's similarly, and the Baltic Dry again is much lower. The cost of freight shipping. So I don't know. I mean,
we're getting a crack in energy prices too in the last month.
I think so. I think that's right. I mean, I think in a sense, you sort of said it about what I'd said to you before with rather more certainty, I perhaps think, than I really meant it. I mean, I think my view in a sense is that there is a plausible counter argument to everything the hawks and the rate risers and the soft landing folks have been making. And the arguments I've made are at least as plausible. Well, if they're at least as plausible, then the degree of certainty that these people keep coming out with is really questionable. And I think the likelihood is, I mean, Larry Summers says you've got to get unemployment to 5%. Well, good luck with that. Unemployment's not the variable that matters. The variable that matters is the employment rate and the participation rate, which are already falling. So that's the number that matters. It turns out that just put it technically, if you look at wage equations, what actually matters in wage equations is actually the non-employment rate and underemployment. And the unemployment rate's sort of irrelevant. I mean, I'm a labor economist. I'm telling everybody here, the unemployment rate in the United States today is an irrelevant indicator of the labor market. It underestimates things. It doesn't enter wage equation. What you should look at is underemployment, where workers don't get enough hours, and you should look at people who have been forced out of the labor market. And maybe it's a choice in the sense that their reservation wages have risen. They see the value of work, underpaid work, not being good enough. My middle daughter was a teacher she has 3 children, and basically for her the cost of childcare was greater than the cost of working. The way the salary of teachers had risen, she'd be back at work. She chooses to stay home, and that's what we've seen in the United States. So the amount of slack in the labor market is high and growing already, and people such as Summers and all the central bankers and so on. I mean, I'm a professor of labor economics. I've worked on this stuff for 40 years now, and this stuff predicted 2008, and it predicts every one of the last 6 recessions, and nobody else has got anything, Dale. Nobody else has anything that predicts recession before it happens.
Okay.
And even when it does happen, you don't know it.
Do you know Lakshman Akutin?
Yeah.
Because I interviewed him several months ago, and he was, kind of in your camp. That the recession already, is beginning.
I mean, Dale, there are uncertainties in everything, right? And and in these prediction equations, it's pretty hard to do. The one thing. I mean, this is a plausible argument, and increasingly likely, I think, as you've talked about the oil prices coming down. It looks things like the availability of shipping containers and the supply side stuff is diminishing. But if that's true, then it makes, speeches and stuff that Chris Waller has been saying, trying to talk about the labor market. But if he was in my labor economics class, I'd have failed him. It was completely made up nonsense. Says on the basis of the relationship between the unemployment rate and the vacancy rate, we're going to have a soft landing. Well, very good. It's like, okay, well, it's equally plausible we're not. I mean, the arguments made no sense at all. I mean, I understand there's the gap between vacancies and the unemployment rate have risen, but what does that tell us? That doesn't enter into wage equations. The vacancies may or may not tell us anything, and it may be a vacancy for a brain surgeon in Seattle, and the available workers are in Miami who want to be gardeners. So the mismatch between occupation and region tell us nothing. There's no basis in labor economics for most of the stuff that these people have been saying. So that suggests to you error. That suggests to you macro error, Dale.
Lying.
Good.
Good afternoon, Dr. Blanchflower. No. I've said it before. I don't know if you've heard the interview that Bernanke gave a few years after the crisis, and he was asked, how could you be so wrong about your hypothesis about the housing market imploding?
That it was contained,
and it was contained, and his answer was, because obviously he preferred to admit he was lying than to say he's incompetent. He's like, I was part of the Bush administration, which, by the way, kills any assumption that there is independence in central banks. So, what could I say?
Well, I mean, it's certainly true. Let me just broaden that a little bit. So I get my students to watch these 4 lectures that Bernanke gave at GW on the crisis. And you get to the end and I say to them, okay, so this was about a lack of regulation. It was about people being allowed to take out crazy loans. I said, who was responsible for setting the conditions in the nature of the loans? And they all sit there and they go, but the chairman of the Fed, exactly. So that was the first thing, but let's go a bit further. So I was on the MPC and I was sitting there when the Northern Rock failed, and there were thousands of people in the streets for the first time in over a century. And the reality was that, well, the governor of the Bank of England didn't think banks were interesting or relevant, and apparently had never sent anybody from the Bank of England to Northern Rock in the previous 2 years. So the failure of Northern Rock was a surprise to the Bank of England, as was Lloyd's and RBS, which nearly brought the global banking system down. So it was that they'd taken their eyes off the housing market. They'd also taken their eyes off the balance sheets of banks. And all of it was a surprise to them, because they thought inflation was all that mattered, and we could run economics as if it was a theory seminar at Chicago or the London School of Economics. So it was fundamental failure. It was a failure about understanding what the real world was. And then the last one, I remember coming into the Bank of England and listening to speeches by former and present members who said, yes, house prices are rising, and yes, the house price to earnings ratios have gone really, really high, but this time it's different. How'd that work out for you?
Yeah.
And of course, the reason in a way, Dale, is that if you're in a bubble, you have to think it's not a bubble or you wouldn't be in it, right? And so that was the reasoning. So what gives you faith? I mean, go back to what Bernanke said. What gives you faith to believe that this time round, the people who failed have got it right? And I think the answer is, by default, you probably assume that they're wrong and perhaps Blanchflower is right, as I was in 2008. I mean, I called it in April 2008 for much the same reasons. And now again.
Dr. Blanchflower, if I may ask a question, I'm with you in all your assumptions. I've been saying for quite some time as well that I believe that we're entering a recession. The question is, okay, let's say they assign you to be the Fed chairman tomorrow. How do you handle a situation that you have an over-indebted country to run the monetary policy for? You have extremely high inflation, and you're entering a recession. What would you do?
Well, I mean, it's obviously really, really complicated, and you've obviously got to get the Treasury Department and others to think about it. I mean, the first question I think you have to get to is you have to say. So let me go back. I mean, people ask me what I would have asked Powell at the last press conference, because everyone was asking,
that's a good one.
Is it going to go from 50 to 75? And I have two questions I would have asked people. I would have asked him. And the first question was, what evidence from the real world would it take for you to not raise rates? And then secondly, what evidence from the real world would it take for you to cut rates? So the first thing I'd be doing is I would actually be trying to watch the data, and I would take off the table the idea that we're going to raise rates further. I would say we don't know what's coming. The potential is that inflation would be potentially is going to fall back, as we were already seeing. And we don't want to collapse the economy, because a collapse in the economy would be much worse. So I think obviously it's a great question that you've said, but I certainly think that having mortgage rates at 6%, and the likelihood of a huge crash in the housing market coming, out of the labor force coming, wage growth declining, I mean, just chaos coming. So I would sort of take off the table that we know what we're doing. I would say these are very complicated times. We don't know still the path of the virus, which is emerged. It's still back up at 100,000 a day. We don't know what's going to happen to China. We don't know what's going to happen in Europe. It looks probable that Europe and the UK are headed into recession. I would be much more cautious about policy and say, the fiscal policy perhaps can alleviate some of these costs by tax cuts and oil price help for people at the low end. Can I just say one other thing? So there's a great new paper that's coming out in the Journal of Money, Credit and Banking. It's built on work that I did before, and it shows you what the consequences of actual, if there is any kind of trade-off between inflation and unemployment, which may or may not be true. But anyway, what it shows is that all the central bankers keep telling you that inflation is the only thing that matters. This paper tells you exactly the opposite. It tells you that if you look at things like well-being, so you measure well-being, it says that a 1 percentage point rise in unemployment is 6 times worse than a 1 percentage point rise in inflation in happiness terms. But if you look at pain, sadness, any of these kinds of variables, it's about 12 times worse. So the danger is that you put into a situation a policy to reduce and take away inflation that's not your fault by creating a huge recession that hurts people much more. So the answer to your question is I would be much more cautious about what I know. I'd be much more cautious about what the data looks like. And I would certainly be much more cautious about saying we'll raise rates, because in all probability, the next move that I would be looking at would probably be to have a cut.
Yes, but my question here is, by your admission,
question, man. It's a tough question.
I know, but by your admission, there are bubbles in the global economy, and I totally agree with you. So unless you let the system reset, which where we've taken things probably requires a depression, how do you let all the malinvestments, fix themselves?
I mean, what are you going to do? You say, I'm going to bring the zombies down. my view has always been you try and bring the zombies down. A, we don't know who the zombies are, and B, we bring down the non-zombies too. I don't know. This is a tough one. I mean, it's a reset of the whole financial system. Pretty hard one to answer.
And Danny, any comment on what the IMF is going to do with the SDR in July? I've just become aware of it. That does it matter?
Well, it probably does matter in the sense that the IMF got it wrong in 2008, and then went to a serious mea culpa, saying that we got it wrong. So I mean, the issue I think in place is that globally people are resetting. The IMF and the World Bank and everybody else is resetting their forecast downwards. I mean, look at the most recent World Bank forecast. So I think in a sense that the IMF, if it learned anything from 2008, is that it's going to have to be more supportive than it was in the past. Because what we've got here, but as they said, is a global crisis, baby. I mean, we do. I mean, if you go back to the thing I've talked to you often about, which is consumer confidence. I mean, I've had lots of students working on this. If you look at consumer confidence, the collapse in it, it's exactly the same in every European country, in the UK, in the United States, in Canada, and in Japan. And the reason we've got a global crisis is we've got issues of global food prices, global oil prices, and a global pandemic. So I think the IMF is going to be, and the World Bank is going to be crucial here. What do? Do they try and, are they trying to be supportive, or are they going to tighten? And this is back to our earlier conversation. I think we're in danger of a deep global recession. Then the question is how deep and how long lasting. And if you look in many of the data that I look at, it looks worse than 2008.
Wow.
I mean, I'm not saying it's true. But I'm saying, I'm saying
what you're seeing.
It's plausibly that. And a lot of the times, I think listeners to this program, when you listen to a Fed governor, you listen to a Fed bank president, you say the following thing to them. Okay, you've just argued that, but isn't the exact opposite equally plausible? You say things like, oh, the terminal rate of interest is 4. Well, is it plausible it's -4? Is it plausible it's 0? How do you know that? You're just guessing, and the answer is, well, I'm guessing. Okay, but oftentimes in these situations, we don't have any forecasting. I mean, go back to the question, what would I do? The answer is huge uncertainty. And if you listen to people, it's as if there isn't any uncertainty. You listen to Powell, oh, we got to deal with inflation. We've got to raise this, and we'll do 75 basis points here and 75 there. Oh,
after he had taken that off the table only 30 days early.
Well, now he had good precedent. Remember at the Bank of England, the governor of the Bank of England said we're going to raise rates and then didn't. And then said, this was in the fall, and then said, we're not going to raise rates, and then did. Okay. So why would you believe anything these people say? It looks like they're being pushed by the winds, politically being pushed by a government who says, we have to control inflation, so you guys better do this. We want to argue there isn't going to be a recession, but, sorry, White House, how do you know that? I don't know it. The Fed doesn't know it. And the fact that you get Chris Wallace standing up and blurting complete nonsense about the fact that some relationship between two silly little variables that relate to nothing, he got 8 time series observations. Well, good luck with that. My response to the speeches that he's made is that you can draw a straight line between any 2 data points.
Yes. And, a journalist friend said that, who covers the Fed, said he's never in his whole career, every meeting is filled with such uncertainty because of policy shifting and, I wouldn't go 75.
But Dale, that's right. But it's not really in the rhetoric, is it? I mean, what you said.
It's in the actions.
Yeah. I mean, if in a sense, the uncertainty is because of the world you and I are talking about, and and others talk about on this program. But read Chris Wallace speak, read Catherine Mann's speech. It's like, okay, I took this little tiddly macro model that people wrote about in 1993, and I look at this and I say, I'll change that and I'll change that a little bit, and I'll write down this equation, and the answer is soft landing. Yeah. Well, okay, fine. I mean, the economics of twiddling. I mean, it's really it's the amount of uncertainty in the world. It seems to me the way you have to do it.
That's the bull market, is in uncertainty. Yes. And also, Danny, everyone is using the word unprecedented for everything. Right. And it's unprecedented. How many times I've heard unprecedented in the last 3 months.
So how the hell do you know what's going on? So the story I like, Dale, is the following. If I was sitting as Fed chairman, I would have the staff do something like this. There are 4 plausible scenarios that we could go into in the next couple of years, and here they are. Inflation tumbles, and we actually we have a pretty soft landing. Second, inflation doesn't tumble, we don't have a soft landing. Number 3, there's another wave of, and you go through each of these scenarios and you say, in this scenario, if this happened, this is what we would have to do. We'd have to raise rates. We'd have to create a big recession. Here's what we would do in scenario 2 and in scenario 3 and scenario 4. And then at the press conference, you say, well, Chairman, whoever it is, Smith, which one of these do you think is going to happen? You say, I have no idea. It's unprecedented. I don't know. And yeah, the danger is we haven't had policymakers saying the great word that you just said. It's unprecedented, and I don't know what's coming. And if you listen to the debate and you read the minutes from the FOMC meeting, read the minutes from the MPC meeting, and I read them and I think, you're out of your minds. You don't know that. You're just making this up. I mean, the Bank of England was amazing.
Is it the role they play to project confidence even when they don't know? Is it a little bit of their, Hollywood face? Huh?
I don't know that. I mean, a good example, I don't know it. I mean, it's just, you don't want to, they say stuff which you and I don't believe. I just don't believe it. I mean, the lovely thing on the MPC last week was that, so the minutes come out on Thursday and they announce their decision and they say things like, oh, the labor market's looking fine. But the day before, so 24 hours before they print their decision, the unemployment rate went up. So the day they print it, they've missed the fact that it went up the day before, but they haven't spotted it. So ex ante and ex post, they're wrong. They say it doesn't look like the labor market's loosening. Well, okay, so why would I believe a word you said when a day before you published your decision, it showed that what you said in your decision was wrong? Surely, if you're going to publish the thing on the Thursday morning, you might have taken out what happened the day before. So I just think they're resorting to theory. They're resorting to thinking about what happened in 1970 when union power had risen. We hadn't actually at that time had a global pandemic. How can you say that some little back of the envelope, silly little twiddly model tells you anything about a world with war, pandemic, global issues, the
confluence of all of these issues.
The confluence of all those issues, and also think about the behavioral changes that have come. Long COVID still exists in the society. The David Kotok is very concerned about its role. All of these people have withdrawn from the labor market, perhaps because their reservation of wage has risen. I mean, I think that's a big part of this story. People were working, they realized the value of their leisure was perhaps higher, as I said, than the value of work. So they've withdrawn, maybe just for now, because they think that the way to think of it is their reservation wage has risen. And so if you start to cut reservation, you start to cut out your wages, all that's going to happen is people are going to leave the labor market, output's going to fall, you create the recession. And to argue that we raise rates so that we can cut rates when a recession comes is nonsense, because you caused the recession. But the uncertainty about the mechanism...
They caused the tightening too, to some degree, don't you think?
Absolutely. Of course, they talked, I mean, in a sense, the decisions, and when the Fed raises rates, it does nothing because the market's already priced in by their stupid talk that a rate rise is coming. So now you're in a position that if you don't deliver the rate rise, the market responds because they've assumed that you were going to do it because of the silly talk you made that people believed. And I certainly would not be in the position of trying to, listen or believe what they said. Oh, you can see my picture. That's my fish.
So, I'm saying that with all the uncertainty, you feel much more certainty on the water when you throw your line in the water, don't you?
I do, Dale, but I think I do want to sort of put over that I don't want it to be said that I know what's here. I don't know what's here, but I have a degree of uncertainty, and obviously I think the positions that I've put out are equally plausible. And increasingly, on the balance, that maybe when we talked last time, it was a 50-50. Was Blanchard right? Were these guys right? On the net, around the world, we're seeing a move to suggest it caused the recession is coming. But where is the debate and the discussion about the things that I have talked about? And if it's plausible, then they're plausibly wrong. And every single time I do think we should say, okay, how do you know that? And is the opposite plausible? Is the
Yes.
so how do you know that the neutral rate of interest is 4? Why isn't it 0? Could it be 0? And each time someone says it in a speech, you put your hand up and you say, okay, you say it's 4, but could you exclude the possibility that it's 0? No. Thank you. Sit down.
Yeah. I always felt uncomfortable saying I don't know, but have found that there's wisdom in being aware of it and saying you don't know. And
exactly. And Dale, what you say is, I don't know. Here are the plausible outcomes. We'll see which way it goes. If this is right, then here, and if that's right there. But that's not what they're doing, and that's what's got them into trouble, and that's what's got the market confused. Because then they have to say something else, and then they say something else, and the governor of the Bank of England has completely lost the plot. Nobody knows what to believe about what he said, because when he says it a week later, say the opposite. So you just discount it and say they've no idea what they're doing, which is probably the right answer. And the likelihood is, if they think they know what they're doing, then the probability is they're going to do something wrong. So I just think we're in a world of macro era, Fed created recession, Bank of England being in a position. So, strikes are taking place. The governor of the Bank of England says workers have got to take pay cuts. So what's that done? Well, workers are going out on strike because they say, well, maybe the bosses who had huge payments and the shareholders have had big dividends. Right. Maybe it's their turn. So now you said something, and what you've done is you've generated exactly the opposite by saying something that was silly.
Well, Danny, thanks so much for being here again, and and your work outstanding. And even though we're probably going to hit new lows in the happiness index, I'm pretty sure we aren't they being magnified by this?
Absolutely. So you're on my webpage. If people want to go there, there's lots of papers. If you click where it says journals, and you click other papers down, that we have lots of papers there. We have papers about showing that people are in distress. People are suffering because of the COVID crisis. The COVID crisis. Exactly. There we are. There's the book. The book I had. If you go to journals, go back to the journals one, just a little bit above it. Click on that, and you'll see there's lots of new papers. So papers on the economics of walking about and predicting unemployment, and looking at COVID and mental health in America. This is about the fact that anxiety has risen dramatically. So people have suffered. They're very anxious about what's gone on to levels that we've not seen before. And so then all of a sudden you say, "Oh, we're going to impose these rate cuts." Well, people were much more anxious than they were in the past. And so the Psalm rule in predicting the Great Recession across countries. So this is about, do these central bankers know what they're doing? And the answer is, it turns out it's much better to ask people. You ask people, what do you think is going to happen to unemployment? Turns out that's much better than going to a Wall Street firm and asking them, tell us how you predict unemployment. Go and ask people. Turns out they know. So that's what this is about. And people beforehand will tell you a recession's coming, and my work tells you that you should believe them.
Excellent, Danny. And wisdom from the man on the street compared to the man in the palace. Wisdom of the crowd. That's right.
Absolutely. And what's interesting in this work, Dale, is that very often, if you go look at what firms are saying, so you look at business surveys, turns out the business surveys and consumer surveys track each other really well. Consumers know what their bosses are thinking. Consumers know what's happening in their local community. It turns out, you go and look at these surveys of, they are PMIs and various
right.
Those things. It turns out they predict really well what's coming, much better than economic forecasters do. So take the wisdom of crowds. And if people say their confidence has collapsed and people think there's a recession coming, guess what?
Okay, and here's your review. There's a quick review from Anthony. It's great to hear from somebody who gets it. Thank you, Dr. Blanchflower. That was great in the gloomiest way possible. LOL, fantastic interview.
Thank you so much, folks. Always enjoy coming on. And people write to me. My email's there. You can write to me. Have a look at these papers and try and this is about trying to understand how the real world works, rather than write down some little theory model and pretend you know. This is about go out there, ask people, look at how the world operates, and try and understand it. And that will inform share prices. It'll inform bond prices. It'll drive markets. If people's sentiment If you understand sentiment, you understand outcomes.
It's great to have a voice like yours out there. You're a watchman over the central bankers. Really appreciate it.
That's what I try, and I get lots of grief.
Well, yeah. Yeah, well, then something you're saying is resonating when you get grief. So
can I tell you one thing to make you laugh? So
ahead.
when I was in the UK on the NPC, my daughter was there at the University of St Andrews, and one day she called me up and she said, "Daddy, it's awful. They're really going after you. Some guy has called you an idiot without a village." I feel like with you guys, I found myself a village.
Yeah, you got a couch with me, Danny, anytime.
There you go.
All right?
There you go. You're my village.
All right, buddy. Danny Blanchflower, everybody.
Thank
the
you.
one and only. Thank you, Danny.
Sure. Bye.
Adios. And thank you, everyone, for being with us. And could join the team in 10 minutes. That's a wrap. And what a great way to start off the day with Danny. Really appreciate his time and his views. And,
like
go check out.
I'm reading the comments; they're nice.
Yeah, and go to his website and learn.
You can email me. My email address is there. If you've got comments or want to ask me things, just email.
Yeah, I mean, how many people offer that? So there you go. His giving nature. You have questions, Danny will answer them. All right, that's a wrap, everyone. Don't just count your pips, count your blessings, and be kind to others and giving if you see fit. Adios, and we'll see you all tomorrow. Thanks again, Danny.
Yep.